And here it comes, the weekly market recap. Once again, Sunday morning. Now, today we got a little bit of a cloudy weather, and temperatures actually went down quite substantially this week. So, yeah, I'm cold once again. You wouldn't bet on it, right? But anyway, it was a not so interesting week. We can straight away go into the calendar. And what we got was basically the CPI, which is, as usual, the most important print of all times, up until the next one, right? And what we got was retail sales and probably for the US PPI, but I wasn't I wasn't paying that much of attention to PPI this week, obviously with CPI coming in. Now, what did we what did we get for CPI? 2.6. So already I'm starting to read. See that inflation reigniting itself. We are gonna go for another round, another wave of inflationary forces storming in. And again, uh, I recorded many videos on it. The latest one was that one talking about why I don't think Paul Tudor Jones got it right on inflation and therefore yields and bonds and whatnot. So if you want the whole story about it, just go back. I think it was 2 weeks ago, maybe. But you know, without getting back into the whole plethora of indications and historical reasons and data set, which would suggest the that huge legend might be wrong. Just I found something new just for the sake of it. This is basically a long-term history of interest rates, GDP, and inflation. And when you look at it, beside the fact that we are basically on a downward trajectory since the 70s, 80s, whatever what you notice is that basically those periods where inflation was actually coming back up and staying up at sustainable levels, so to speak, was at the beginning of the century, uh, mainly because we got the Industrial Revolution. So, growth, inflation expectations, wages going higher, productivity increasing, and whatnot, the usuals, right? And of course, after the World War II, for historical reasons, well, if you think about it, the US came out on top after World War II, and well, not only them, but you know, the rest of the world, when it comes down to the industrial powers, they were all bombed, so burned to the ground. So there wasn't any industry being able to produce stuff, to manufacture stuff. So the US became the epicenter of the world when it comes down to production and manufacturing. Therefore, what happens is that you got wages going up, uh, productivity increasing, and you got more spending capabilities, therefore more demand. GDP goes up, and then and so goes inflation. Now, on top of that, throughout the 70s, you also had a few imbalances like oil embargoes and whatnot. But that actually that period has an inflationary premise behind it, but we don't have it right now. And the recent surge in inflation after 2020 was mainly due to supply chain disruptions and supply demand imbalances caused by the response to the COVID pandemic. All right, just a recap, which is I don't know. I think it's particularly good. Like when you start to look around and to zoom out on things, you can clearly see that some trends are really set up as long-term trends. It helps a lot to clear out a lot of the noise, I think, because we do live in an era where you constantly pick up your phone, open up Twitter or whatever you, and you read a narrative from someone that you don't even know. You don't know his background. You don't know who he is, what he does, and whatever. But at the end of it, I just think we pick the narratives we like the most, and that doesn't necessarily means that they're gonna they're gonna be good narratives, or you know, hold any truth into them, right? So that that is a nice representation of what happened over time with the actual logics and reasons behind it. Then of course, if you look at the composite, so the main drivers of inflation, right? Wages, GDP, and sorry, the main drivers of economic growth, right? The wages, inflation, GDP, and you compare them to rates, which should move, accordingly to the previous factors. Well, basically, you see that all of them are on a downward trajectory, if not for that recent spike. But already we we just cleared the air for it and the reasons behind it. And when it comes down to the debt, you can see that basically, although you might say, yeah, we're going to spend a lot, we're going to have more government spending, and the government will provide new money to be spent and to fuel the economic growth. Well, it's been tried in the past, but if you start to look at a long enough, trend, you see that the more you use the debt, the slower the economic growth actually becomes, and so the smaller the economic output actually becomes. And again, this is another thing we went through in that Paul Tudor Jones video with the debt negative multiplier and whatnot. So this is just 3 or 4 slides to reiterate the fact that at the end of it, inflation and therefore rates are just a reflection of future growth and inflation expectations. Did I just say inflation 2 times? Yeah, right. But you got the gist of it. It is all connected, and there is a very good correlation, as you can see. So before betting your farm of such bold claims read on the internet, just maybe give it a little bit more thought and try to seek the evidences which might confirm or deny the thesis you are actually trying to pick and make yours. So, other than that, nothing really major on the calendar for this week. So, just a quick look since I didn't bring that up for a while now. So, the yield curve still uninverted, but it's just hovering around the zero line in here. And we do know this process, it might take a bit of time, but ultimately we should start to see a full-on inversion, or at least, again, that would be the historical pattern. Would you keep the doors open for this times different? Well, it might be a non-zero chance, of course, but having to bet, I know what I would bet on, right? No, the break-evens are for later. So let's just jump into the charts. Start out with currencies. Nothing new. Dollar strength. It's basically the same as last week. It's just trend continuation, right? The dollar actually broke out of the macro range as for now, reaching into the first level of deviation, while the euro is basically taking out these lows right here, starting to crack into this area. I am not I'm not a particular fan of stuff like this. So, all the liquidity in here is particularly washed out. It's being picked up multiple times before they run up. I, I'm really starting, as a European, I'm really starting to fear that we might see the euro as a currency going really, really down against the US dollar. I might be wrong, yeah, of course. I can always be wrong, but it is just all in all. All right, let's play the game. What target would you pick? Let's zoom out on a weekly time frame. Hmm. I mean, I guess, yeah, 1.02 something would be likely at this point, if not lower. Um, I would expect to see the euro trading back down in this area, in this pocket right here. It could be just below this low. It could be a little bit of a deeper type of a push, but yeah, conservatively, I'd say 102, right? As for the pound, yeah, probably this low. This area right here for a major bounce could be good. First target would, I mean, a major, well, maybe not major. It depends how you classify a major bounce, but this area right here would be kind of cool for at least a starter step, and after that we'll see. But ultimately, again, I would think we really take the chance of revisiting 124, if not 122, right? So again, I'm still bullish on the dollar. Long term, of course. It doesn't mean that both the euro and the pound could actually bounce back up the next 2, 3 weeks before coming back down. Same as the dollar, the DXY could just pull back a little bit, reaccumulate, and then going higher. We will see. But at the current moment in time, that would be my interpretation of it. The Japanese yen in here is kind of interesting at this point. Let's get back to the daily time frame. We are retesting this pocket right here, which was basically the major base before the run up with the in August with the carry trade unwinding. It is it's interesting to me because just coincidentally, this test is coming in when we are gonna have on Monday the chairman, the president of, or the the governor of the BOJ coming in for a press conference, and it's not it's not something which is particularly widely spoken out on FinTwit and whatnot, but I just think it might be particularly interesting because the BOJ is basically set to move rates in the middle of December. So I know it's basically 1 month ahead, but depending how it comes out, referring to Ueda, I guess the name is, if he comes out particularly hawkish and it kind of send out the message that, yeah, I mean, we tried to raise rates back in July, August. We have seen the reaction the market has, or should I say had back then, right? And therefore, if you remember, from that moment, they started to be a little bit more dovish, to not puke the markets too much, to not basically adding fuel to the fire of the carry trade unwinding itself. But if it comes in particularly hawkish, like, yeah, we paused for 2, 3 meetings, but it's now time for us to actually pursue our own domestic monetary policy. And if he kind of gives out that message, we are going to hike, I guess you're going to see a movement in this pair right here. And most likely it would be the yen strengthening against the dollar. Technically the area is right for a bounce. If you fuel that up with a little bit of a fundamental type of a news coming out from a central bank, um, I mean, that could be. There is a huge amount of leverage in the carry trade. So, I mean, even a slow movement, if it is sharp enough, could actually scare some people out and basically force them out of their positions, or force them to reassess and therefore manage risk, which, it's snowball from there. Just pay attention to it. It might move markets. And remember, it doesn't only impact the FX market. If you think back of what happened in August to the S&P, the beginning of August, I guess, don't remember if it was the first week of August, right? So just check it out. Gold, at the end, it looks like it put in a little bit of a local top. The pattern for these pullback was particularly nice and ordered so far. Last week we closed down the week and it was in here basically. Then after the first bounce on support, we failed to keep up this bounce. It wasn't extended. It was faded. We break. We broke the support. A little bit of a study step at the lows right in here. If you remember, I was talking about these 2,600-ish area. A little bit of a stutter step there because we bounced initially, then we crushed it, then we came back up, retesting it right in here, and it was rejected. So next stop was in this pocket, right? Um, we bounced off of it, and now it's kind of the same play that you've seen in here. The question becomes, does the bounce get extended, maybe retesting a few levels to the upside, and then what happens next? We confirm them as support being flipped resistance, like it was kind of in here, although you didn't really have the actual retest, but or more or less the dynamic was there. Or we can reclaim that and start it to climb back higher again. At the current moment in time, with the euphoria you see in other markets, I wouldn't put that much emphasis on gold actually resuming the rally. I guess if you are a gold bull at the current moment in time, the best case scenario would be a little bit of a consolidation, right? Also, because if you look at this base right in here, it's particularly thick and it's particularly compact. It's not ascending like we've seen on the euro. It's clearly defined. So I mean, maybe it's just me, but I wouldn't expect it to give out at first pass. So a little bit of a consolidation first, and then after we consume, after we deplete and we erode the liquidity base, we might see it trying to go lower. But I, it was, on top of it, the move to the downside was particularly extended. So I don't know. I'd say consolidation, because I don't feel like there is that type of a bullishness you got before. But at the same time, when I see structures like these, I'm always hesitant to call them defeated at first pass, right? So oil was a little bit of a bitch recently. I mean, eventually, it's still in this range, right? And it looks like it's becoming weaker and weaker. But with all going around throughout the rest of the world, you never know how much is gonna squeeze you out. Let's say you're short, right? Like, for me, you do know I got a particularly bearish outlook on oil. So let's try to imagine this scenario. You want to short this market, or you already short this market, and it looks like eventually it is going in your favor. It's going your direction. But look at how, and how many times it's coming back up to potentially squeeze you out, which is why I say this is a little bit of a bitch if you are trying to swing it with a clear and defined trend in mind. Uh, it's not, I guess it's not an easy market. It's a volatile market, so if you are an intraday trader, you might have fun with it, but for a little bit more of a long-term swingers, it could be a bit testing, I'd say. Now, all in all, we are still hovering around the lows. Uh, it, I'm not gonna lie. To me, my personal opinion is that it looks heavy. It starts to look heavy at this point. We got one bounce, one extended bounce, came back down, bounced again, came back down, didn't break, come back again, and now is down again. I mean, how many times would you expect this area to hold if you keep on testing it again and again and again, right? I mean, at a point, the liquidity which is present should be eroded. So, for lower targets, you would really need to look far back. So basically, this level right in here, but was tested once, kind of tested twice, been in here, and mind you, price close here, 66.95. The level would be 63.65, so we're not that far out. Uh, kind of like the same of gold. Like I wouldn't expect this level, which is not really a level. It's quite a large area from 63 something down to 61. So I wouldn't expect this area to give in at first pass. But you know, keep on focusing on the short term. If I had to pick a downside target, my ideal one would be 63.60, just to be conservative. And probably with the potential to push a bit lower if it really wants to come down. But as I said, this market made evident that it's not it's not an easy journey back down to those targets. So just be aware of it. Let's bring in the break evens and let's see what they say. Let's zoom in a little bit. Hmm. Does this look like a peak or a top? Uh, don't know. These break evens were particularly, well, basically as the price action in oil, but it was particularly noisy recently. You know, you kind of take into the same context of what's happening with yields, right? And all we discussed in last week's video with Trump being elected and these new kind of optimism, right? Which in economic terms would be translated in future growth and inflation expectations. Um, which again, I went extensively over it in last week videos, but what I'm trying to assess here is just who's right, who's wrong. Is the price of oil right, or are the break evens right? Past examples show that break evens tend to be right more often than not, but I mean, if I got if I gotta be consistent and faithful to my own beliefs and long-term thesis, I'd say for better or worse, the signal, which is kind of more in line with my thesis, would be the actual price action in oil rather than the break evens. So again, I would I would still maintain my stand of lower oil prices, lower inflation, lower yields, and all the rest. Let's have a look at Bitcoin. Well, I mean, what what you're gonna say is it's just a consolidation. I got a huge run up, and I guess a consolidation at higher levels in total price discovery. It's not bad. I mean, it wouldn't. Let's face it, it wouldn't be bad from a macro standpoint, even if this market pulls back. Like what could it be? I mean, even if it pulls back a 15 or 20%, it is still a bullish market, right? It's kind of like the same we were talking about when it comes down to equities and the indices. Well, we are going to transition to that in a minute. So, I mean, I guess it's just again, people tend to be fearful when things are actually going well, because now if you read or if you check a few, uh, let's say Discord servers, blogs, chats, Telegram channels, it is all like, so when when the next pullback gonna come? First of all, why would you assume a pullback is about to come? I mean, let's just say it wouldn't be unusual, but there is no sign from a structural standpoint. There is no signs of a potential pullback coming in. I mean, even if you zoom in, let's say you want to look at the 4 hours, right? I I don't yet see a pullback unfolding itself. I mean, it's like kind of like this. How would you want to uh, set it up? Like, could this be? I mean, if you like patterns, could this be symmetric triangle? And then you might just want to wait if it breaks to the upside or the downside. I mean, if I'm not a little bit of a disclaimer. I do not trade these patterns, right? But I do remember I kind of went over them in the past. I'm talking like 4 or 5 years ago, maybe. Now, as far as I can remember, when you got something like this, it tends to be broken when it comes near the end. So when the two trend lines should converge and touch themselves. And, if it breaks to the upside, it is a bullish resolution. If it breaks to the downside, it is a buried resolution and it should go down. So I'd say up until the point you at least you start to break this trend line, the lower one, I wouldn't call for a potential pullback. I mean, I just don't see it. Then again, being Bitcoin, it might be that you wake up on a casual Wednesday morning and it's down 15% in an hour. You never know with Bitcoin, right? But I guess at the end of it, if you are a Bitcoin trader or a Bitcoin investor or holder, um, that would just assume that you knew what you were signing for before you did. And if you didn't, probably the market is going to teach you that in due time. But, jokes aside, I'm not seeing at the current moment in time particularly worrying signals from Bitcoin. If not, for shorters. But if you try to short this market, just you should be worried at this point, I guess. So yields, yeah, again, yields. If you remember, I was talking about a potential uh, top information coming in on the long end, which wasn't nowhere near to be confirmed. Actually, we traded back up. Same for the rest of the curve. It's still climbing higher. So again, that is cool, I guess. It's all fine up until the point it goes one way or the other, particularly slowly. It shouldn't bring in too much disruption for the rest of financial markets. So, uh, yeah, no pun intended, but so far, Paul Tudor Jones is being right. Is it? Huh? Right. But I mean, it's some sort of a philosophical bet that I took on, not expecting it to win it. And at the end of it, there is a reason if he's a multi-billionaire and I'm a peasant, right? Still, fundamentally, I hold my ground, but we're gonna see what happens next. Again, picture these. What might happen just this is not some sort of a crystal ball type of bullshit. It's just in terms it is an honest question, right? And I will try to answer that on my own throughout the rest of the week. But what happens if Ueda, the Japanese chairman from the BOJ, came out particularly hawkish and clearly signaled the markets that they're gonna hike? What's going to happen? They're going to hike while on the other side of the Pacific, the Fed is still on the course of cutting. Uh, how does how does how does it work for for the yen carry trade and therefore for the amount of leverage which is implied into this financial system? And considering that most likely all that leverage has been used to purchase U.S. assets, namely equities. That would be interesting to see, I guess. But again, it's not a prediction. It's just as I usually do, just try to scan the overall landscape for potential risks and headwind. Or no, fuck. I always get confused. It's headwind or tailwind when it's negative. A tail should be negative, right? But anyway, potential risk factors. Let's put it this way, right? Then, of course, the if you look at the bonds, we know they move in an inverse fashion compared to the yields, so of course they are down, and they have kept on going down throughout this week. With well, the long end starting basically what was that Tuesday? That was a very sharp rejection. It looks like they are moving in this downward channel for now. Getting back to last week, my point for you know uh, cautiously switching to be a bit more bullish on these would have been to reclaim this level right here. We didn't. Absolutely didn't. No chance. So gotta be patient if you want to bet on bonds. But at the same time, if you are patient enough, if you are patient enough, there's gonna be that moment where everyone is particularly uber giga bearish on bonds and massively bullish on stocks. And therefore everyone will be on the same side of the boat, and the boat will naturally shift to the other side. That's what always happens in markets. So just if you like these type of assets, be cool and just wait. Uh, if you don't like, I mean, I talking from personal experience here. If you start to dislike it, or if you start to think that the price action you see it's not particularly conducive to your position, just the risk. Just especially if you got good entries, just take a little bit of a profit, right? Trim the position down, and this way you're not gonna give out or give back a lot of the profits, and you're gonna mitigate risk, and you're gonna sleep better at night. Look, whatever type of position you got, it could be medium term, long term, whatever you. One of the first rules is that if it if it's keeping you up at night, that is not a position you should be in. So you can't go mad over markets, right? Otherwise, your quality life would be shit, and most likely your decision making process will be fucked. So if you start to feel like you are in discomfort with your positions, just trim them down. All right, that would be an advice that could help maybe. Now, let's move to indices. Now, forgive the messy charts, but that was a little bit of a thought I was giving to them throughout the past week. I was just noticing that if you check, right, these indices, just recent time, this is not some sort of a long data series type of a study, but I was just noticing, just for the sake of it, right? Because now everyone is talking about Trump, how his policies are going to be, beneficiary to the Dow, the small caps, because you want to lower rates, so you want to increase production in the US. And usually that should go well for the small caps and the Dow. You're gonna bet big on the domestic industrial sector of the US, and at the same time, if you lower rates, you get back to a very easy financial conditions, which usually are the most favorable to small caps because they're not a lot of capabilities when it comes down to finance themselves or refinancing and rolling over the debt they got already if rates are too high, right? Because they don't have the same capability of borrowing, right? And they don't have the same cash flow, something like the big caps might have. So I was just looking at it and I was saying, okay, so from the lows of the pandemic after the stimulus, the stimmy checks, the PPI, whatnot, they all run up pretty much in lockstep, right? I mean, some maybe one of them actually perform better than the other, but what I was interested in was after the sugar rush, so to speak. So let's say 2020, 2021, and I took basically the beginning of January 2021. And I said, all right, overall, if you look at the current highs for all these markets, it looks like the Nasdaq from that point onward returned a maximum of 65%. All right, the S&P 61, the Dow 46. If you look at small caps, so the Russell, only 24, right? And mind you that throughout that period, we got the huge correction of 2000, the end of 2021, all throughout October 2022. And throughout that period, if you look at the drawdown you might have faced if you were invested in these, so you faced a 37% drawdown on the Nasdaq, and you faced 27% drawdown on the S&P. Um, I'm I'm much more shallow, 22% on the Dow and 33% from peak to trough on the small caps. So my logic was, look, I know it is just 3 years, right? Just 3 years. Sure, it's not a huge amount it's not a huge data set, right? It's not a long enough period of time. But would you hold something that when it puts you into a drawdown, it's much more severe than the Dow and the S&P? It's kind of in line with the Nasdaq because, 33, 37, it's kind of in that same ballpark. But at the same time, when it goes up, so when it's yielding you, when it's returning you profits, it's basically giving you at least half of the others. You know, the Nasdaq would have returned you more than double the small caps. Uh, S&P kind of the same logic, and the Dow would have been actual, 24, 46, almost double returns. So what's the point in investing in the small caps? Over time. Then, of course, if you want to play short-term positions, I'm all years, right? It's all cool, but it's just I don't see that opportunity. And again, I don't believe this Trump election it's gonna change things around that substantially, at least in my view. It could be different. Let's say we fast forward 1 year and we see that Trump is making an amazing job with his policies and he's implementing everything he promised and everything is rosy and the economy is booming. Yeah, at that point I might change my stand on it. But again, right here, right now, I would say I don't see a logic in being invested for the long term in the small caps, while you got the others. So that would be me. Um, as for the this week price action, we got a little bit of a pullback, and yeah, I mean, it's not really my style, but I don't mind taking a little bit of a victory lap, right? From time to time. That was just 11 was a Monday, right? Yeah, Monday, just 1 hour into the London session, and it was really looking like the week might would have been a little bit of a pullback. So again, it's nothing, it's not like a huge call, right? Because again, if you look at how these markets moved after the elections, you got this huge run up, a huge deviation away, especially from the 55 moving average, right? We made new highs and we left these huge gaps. And now, again, we are just, if you check, we are basically back. We gave back all the election rally, more or less, right? So, which is why I was saying, the market was a little bit ahead of itself. And the euphoria of the elections, and everyone was buying, 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 buying. And, what goes up so sharply, it usually comes back down sharply enough. That doesn't mean that I changed my overall big picture for indices. I actually still think they're gonna perform well from here to year end. Um, just bear in mind, you got a little bit of a dynamics as for the calendar and as for you know portfolio rebalancing and what might happen with these huge institutions. So, in short, we are getting into Thanksgiving week. I'm actually expecting a little bit of a light volume trading throughout that week. So probably I might say not huge runs, right? And after that, I'd say if these markets can consolidate or start to grind back higher again from these levels right here without breaking any structure, without breaking any moving averages, which is particularly relevant, like in this case would be the 55, right? I still think there is the potential to go for a run into year end. And you know, just wait for Thanksgiving, and then I would expect a little bit of a run up until the beginning of the second week of December, more or less. But, in between the first and the second week of December, because at that point you should have mutual funds distribution. So what do? They basically have to distribute the profits to investors. And how do they do that? Well, they need to actually liquidate something in order to get the money to then send out into the client's bank accounts. So you might have a little bit of a pullback there just for these dynamic. This is also a good period for loss harvesting, right? If you are into that kind of dynamic, so you basically harvest the losses so that then you can compensate the profits with the losses. It is just fiscal dynamics. But one way or the other, they tend to have a little bit of an impact on markets. And again, I'm not calling a reversal. Just let it be clear, because every time I start talking about potentials, that this and that, everyone assumes I'm giga bearish once again. I'm not. I'm just saying the market overall, I'm expecting it to keep on going a little bit higher than that, but just bear in mind, after a huge shot to the upside like this, it is normal to have this type of a pullback. And overall, there are dynamics at play in the coming weeks and months, which could, on one side, push the market higher, but on the other side, adding a little bit of volatility potentially to the downside. All right. Overall, the picture remains bullish, especially because, you know, we got the factors we discussed a few weeks back. Performance chasing by money managers and portfolio managers. We got buybacks coming in at a rate of 6 billions per day from here to year end. So again, that is another major buyer into the market. And overall, if you check, we are particularly optimistic, which again is another double-edged sword, so to speak. Now, if you remember last week, we were looking at these. So what happens in election cycles? And again, from 1932 up to 2020. So this time around, we are looking at a good data set with enough sample sizes in it and a huge time spent to back it up. Now, I found this, which is it might be interesting, right? Now, you see, this is just recent times, okay? So 2012, 2016, 2020, and now 2024. If you check the different colors for the different election cycles, the difference is that this time around, we didn't have uh, that much of, don't want to call it pullback. When it comes down to positioning, right? This time around, there was not that underweight type of a phenomenon that you've seen in past election cycles, right? So it looks like the way I read it, it's like this time around, the general crowd, the investors community, was a bit more cavalier, uh, bold, right? Exuberant, and therefore they were already exposed. We again, why I say it could cut both ways, because on one hand it shows you that there is a huge confidence in markets, and therefore you might expect a lot of buyers coming in. On the other hand, it might suggest you that these run up, that could be sharp, could be not sharp, could be huge, could be a little bit less huge, but the run up to come, if we assume it's going to come, it might be, I'd say, a bit more short-lived, because it's kind of like if everyone was already weighted, they already got positioning, so it's like more people have already bought in. All right. So the ones actually catching up are those which didn't have enough exposure. Maybe they were too defensive or whatnot. Honestly, I can't speak for other people, but it is just an interesting data. Then, I mean, you read into it whatever you want. At first glance, I took it like this, right? And if you check the confidence for the next 12 months returns of the stock market when it comes down to consumer is particularly high, which again is a little bit of a potential warning sign for the coming months. Again, I want to stress that out. Months. I'm not talking tomorrow, right? So just put it on your radar. It might help you to manage risk because it's kind of like when you. This is not to be derogative, derogatory, but it is just consumer, the quote unquote, the plebs, your mom and pop, your uncle, or your cousin that you never hear, you never pick up the phone to call you. When you start to see these guys actually picking up the phone and coming at you, oh, you're interested in finance, right? Right? Are you? Yeah. Um, what you say is it too late to buy into gold? Is it too late to buy into the S&P? When you start to get a little bit of that, those are usually consumers, or the average Joes and Janes. So it might be a little bit of a warning sign, right? So just beware, beware of that. And again, even if you check, there is a good correlation in household equity ownership when it really starts to go up. You see that usually you got correction. Again, we're talking corrections. We're not talking massive reversals or 2008 financial crisis type of things. Still, is something that you should notice and you should take note and keep it on the desk for when the moment will come. All right. Don't think we got a lot more of these. Well, yeah, I mean there is still the argument for high valuations, but honestly, at least, I mean, feel free to disagree, but for what I've researched, it looks to me like, yeah, valuations, they tend to give you the big picture overall over the long run, but in the short term, they're not such a good market timing tool. The way I see it, they oftentimes they just reflect uh, market participants' psychology. What do I mean? If you are willing to pay a much bigger premium to own a stock on, the premise that earnings are going to be even larger and bigger into the future, that just shows that you are feeling particularly optimistic about the future of that specific company or the economy or one sector of the economy on its own. But it doesn't really give a lot in terms of timing market movements. So it's another thing that you might keep it there, and you see, over time it tends to work, but there is never really a good enough relationship, in my view, to be used as a timing type of a tool. So just um, just because valuations are too high now, it doesn't mean that they they can't stay high and possibly go higher into the coming weeks and months. It's like, the old saying goes, markets can stay irrational longer than you can remain solvent. So just take it with a grain of salt and give it the weight it deserves, right? After you start to realize that historically that's what might happen, right? When it comes down to timing, right? So I guess with that, there's really nothing else I wanted to discuss. Might be that one time we managed to keep the whole thing really below the 1 hour mark. So yeah, again, just a recap for next week. Don't go there and liquidate whatever you got in stocks, or God forbid you try to short them, we might have a little bit more of a push to the downside, like early in the week, maybe. But just, you know, manage it with a little bit of a steady hand. All right. If you got BTC, just I would stay calm for now. I would relax and enjoy the ride. If you got oil, I would wait. On oil, I would wait for what it's gonna come on Monday from Japan and see what happens. All right, it's all tied up. Currencies, gold, oil, treasuries, yields. I guess a lot of that might be tied up to what Ueda is gonna say. Now again, if it turns out to be a non-event, maybe it basically comes out and say nothing. It's not hawkish, it's not dovish, it's just talking random shit like a lot of politicians often do. Well, then it's business as usual, and the current trend should prevail in markets. Still, I wanted to stress that out because it could be a catalyst for something if it turns out to be. Just be aware. And with that, I guess, unless you do want to look at which sectors perform better or worse than others in the past 5 days, this is it. You could expand it to the last month if you want it. This is a nice tool. I mean, it's just a tracker. It's not really an indicator or a leading indicator or whatever you put. Sometimes I watch it. It's nice. It just gives you the picture of what just happened and where it happened, right? So it could be nice to spot sectors and stocks which are particularly oversold, or others which are particularly overbought, and therefore manage your risk and positions accordingly. Anyway, with that, I wish you a good rest of your weekend and a good start of the week next week, of course. So again, be nice and be cool. Neil's out.